China started off with this, when Mao Zedong died, this thought, if you like, was behind the appointment of the People's Bank of China to act not only for all the foreign exchange transactions, along with the safe fund, which is sort of seen as a sovereign wealth fund, which is underneath the control of the People's Bank of China. But also in 1983, regulations were produced by the Communist Party appointing the People's Bank with sole control over the nation's gold and silver programs. And it was clear that with that big bear market that we had between 1980 and, this started in 1983, in effect, between then and the year 2000, 2002, there was a lot of gold coming out on the market. These were the conditions under which the People's Bank of China was able to accumulate substantial, undeclared quantities of gold bullion. By 2002, obviously, the People's Bank of China and the Communist Party reckoned that they had got enough gold to secure their currency in the future. And so at that stage, they opened the Shanghai Gold Exchange and allowed ordinary Chinese citizens to accumulate gold. Until then, they'd been banned from owning it completely. Since then, Chinese have taken delivery out of the vaults, the SGE's vaults, of around about 27,000 tons. Some of that would have probably gone back in as scrap, because anything which is resubmitted to the vaults, if you like, is scrapped and then recast. But on top of that, there is quite a lot of gold which is actually owned by banks and also ETFs and other investment funds, which are stored within the Shanghai Gold Exchange's vaulting system. So, we're looking at very substantial quantities of gold. And I reckon that by 2002, I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that they invested a lot of time and effort into both refining gold and also mining gold. And they quite rapidly became the largest gold mining nation in the world. And have held that position for, 15 years now? It must be about 15 years. So, and the other thing is, of course, we've seen gold go from the west to the east. I mean, this was, a story which that's 20 years old, that story now. There's an awful lot of gold has gone into China. And not only that, but nothing comes out of China. I've spoken with directors of the Swiss refiners, asked if they ever see any Chinese refined bars, and the answer basically is no. There was a report of a few bars turning up, and it was thought that those were smuggled out. But, basically it's Hotel California for gold. So there's an awful lot of gold, both owned by the state, and also owned, and not declared as reserves, incidentally, owned by the state and also owned by Chinese nationals. So how much it comes to, I really don't know. But you see that China has a huge interest in the price of gold, if you like, and she has a huge disinterest in the dollar. So what she's trying to run, with Russia and Shanghai Cooperation Organization and BRICS, all these parties, she's sort of, if you like, dividing a world into a sort of schism between East and West. The one thing she wants, if you like, is control over the settlement means for all the commodities she buys, the things that she imports and the things that she exports. And so she wants to do away with the dollar. And part of this is having control over gold markets. And that is why, it's one very good reason why anyway, that now that she, is de facto controls the physical gold market, she now wants to take away, if you like, the paper control, which is very, very much a dollar story. So that's one aspect of it. The other aspect of it, if we go back to what the Marxist universities taught, the Chinese students about how the capitalism would destroy itself. Well, obviously, it destroys itself. The currencies get destroyed, particularly if they're not attached to gold. In other words, if they're just fiat currencies, they will go down the Swanee river as well as capitalism. We can see the conditions whereby this is now going to happen to the dollar. I think as far as the Chinese are concerned, they've expected this. This doesn't surprise them at all. But the election of President Trump, as far as the Chinese are concerned, is accelerating the process of the death of the dollar, simply because he's a spendthrift. We've got that big, beautiful bill going through at the moment, which will probably add, take that budget deficit up to something like 2.5–3 trillion. You've got an economy which, really, when all is said and done, is not behaving very well. It's probably in recession, and it is in recession if you take out government spending. In other words, it's only government spending, unfunded government spending, which is actually giving the illusion of an economy which is growing. Take that out, and you've got a contracting economy. And it's been like that for a few years now. Now, this matters because of all the debt which has got to be funded. And you're going to see interest rates rise. And this is why at the long end of the US Treasury market, nobody can really raise anything out of it. I mean, the government has auctions, and they sort of continually disappoint or fail or whatever. So foreign investment, if you like, in dollars. I mean, they've got too many dollars. They don't want to have any more. If anything, they want to sell some. They want to reduce their exposure to the dollar. Most countries, if you like, in the sort of China-Russia camp, see the dollar as a weaponized currency. They would rather not have, if you like, the risk that the dollar exposes them to. So you can see that the dollar is on a very slippery slope. And of course, this is why gold is rising. It's not so much gold rising, it's the dollar going down. As far as China is concerned, they need to protect their own currency from a collapse of the dollar, which is becoming more imminent.
All right, so let's take a very sober look at the landscape we find ourselves in today. Because frankly, if we step back from the market tickers and the daily noise, we can see something quite extraordinary unfolding. Something that I've spent decades studying from a monetary, economic, and even civilizational perspective. And it revolves around the final unraveling of the dollar-centric global monetary system. Now, some people laugh at that notion. They say, come on, Alasdair, we've been hearing this doomsday narrative for years and the dollar's still here, isn't it? Yes, it's still here, but that misses the point entirely. Reserve currencies don't collapse in a day. They rot from the inside out. Confidence ebbs slowly. Structural cracks widen over decades until one day they suddenly give way under their own weight. If you want a concrete example, look at the British pound. It was the world's reserve currency for roughly 150 years, underpinning global trade from the days of the East India Company right through the early 20th century. Even after the sun began to set on the British Empire post-World War I, it didn't immediately lose reserve status. But by the time Bretton Woods rolled around in 1944, it was already clear the pound couldn't carry that mantle. The US dollar, backed then by gold, was the only candidate left standing. So where are we today? We're nearing the endgame of that dollar era. You can see it in the desperate fiscal machinations of the US government, in the wild expansions of central bank balance sheets, in the quiet but determined way major global players are building parallel systems to insulate themselves from Washington's whims. And this is why China's strategy is absolutely central to understand. Because China's moves on gold, and increasingly on silver and broader commodity settlement, are not just about wealth preservation. They're about building a hard alternative to the US dollar system. Let's rewind to the early 1980s for a moment. Mao was dead. China was emerging from decades of ideological rigidity and economic devastation under the Cultural Revolution. Deng Xiaoping was beginning to steer China towards socialism with Chinese characteristics, opening the door ever so slightly to markets and foreign capital. But critically, in 1983, the Communist Party issued new regulations that gave the People's Bank of China sole authority over all foreign exchange transactions, and more importantly, over the nation's gold and silver strategy. Now, this was absolutely crucial because the gold market at that time was deep in a bear phase. After the 1980 spike to $850 an ounce, prices languished, drifting lower for nearly 2 decades. Western investors were thoroughly demoralized. central banks were actively leasing out their gold, selling reserves to suppress prices. Most famously, the Bank of England under Gordon Brown dumped 400 tons at rock-bottom prices around the turn of the millennium. A financial maneuver that still makes one wince. But to China, this was an opportunity of historic proportions. For roughly 20 years, from 1983 to the early 2000s, the People's Bank of China quietly amassed gold, taking advantage of soft prices and Western disinterest. I estimate that by 2002, they had built up somewhere near 20,000 tons of gold in various forms, much of it undeclared as official reserves. And think about that scale for a moment. The US claims to hold about 8,100 tons. The entirety of official global reserves tracked by the IMF tally to around 35,000 tons. So China's shadow accumulation, not reported to the IMF, not transparent to the market, fundamentally rewrote the global bullion ledger. Then once they felt confident in these holdings, they flipped the switch. In 2002, China opened the Shanghai Gold Exchange and permitted private citizens to begin owning gold. Before then, remember, it was illegal for ordinary Chinese to buy or hold gold bullion. Suddenly, that door was flung wide open, and boy, did they walk through it. Since then, around 27,000 tons have been withdrawn from SGE vaults by Chinese households and institutions. Yes, some of that re-enters as scrap, gets refined and redeposited, but the overall cumulative flow tells the story. Vast amounts of gold have moved into private Chinese hands. Meanwhile, they didn't stop there. China also invested heavily in refining capacity and quickly rose to become the world's largest gold mining nation, a position they've maintained now for over 15 years. Virtually none of this domestically mined gold ever leaves China's borders. It's a one-way valve. Swiss refiners have told me directly they almost never see Chinese bars being exported back into the international market. Once gold goes into China, it's like the Hotel California. It checks in, but it never checks out.
I think that informs their recent moves, which basically are, they've said that they will open, or at least the Shanghai Gold Exchange, which is completely under the control, incidentally, of the People's Bank of China. They've said that they will open a vault in Hong Kong, and they have also said that they will open a vault in Saudi Arabia. Why? Because Saudi exports a lot of oil to China. Saudis want to be able to trade yuan for gold and gold for yuan. I mean, quite obviously, because of their trade. And I think you may well see other ones, other vaults being opened. This is all part of the internationalization of the yuan. And then only, last week or 8 days ago or whatever, it was announced by the Shanghai Futures Exchange that they would open up the futures exchange in Shanghai to foreign participation. A foreign bank can deal on the Shanghai Futures Exchange at the moment, but it has to do it through a Chinese entity. That is all going to go. So, and this is obviously not just gold and silver, it's also base metals. There was the nickel problem, if you like, in London when a whole load of trades had to be cancelled by the London Metal Exchange. That was a bit over a year ago now. So they want to take control over all this, if you like, at least to their advantage. Now, I think that one of the points behind the internationalization, if you like, the mobilization of gold as part of a trading situation, if you like. I mean, trading not fixed at this stage to the yuan, but obviously trading alongside the yuan. At some stage, when the dollar really does start collapsing, I think you will find the Chinese are in a position to immediately announce a fixed exchange rate between the yuan and gold in order to stop their own currency sliding along with the Western currencies, led by the dollar. This is all after President Trump's Liberation Day. I mean, bear in mind that the reaction from the Chinese was uncharacteristically quick. The first announcement that came out was that they were going to speed up the negotiations for a free trade agreement between China, Japan and South Korea. And then this was rapidly followed by President Xi visiting some of the leading ASEAN nations, which are basically the other nations, if you like, in Asia, in Eastern Asia. I mean, I think I can't remember. He went to Myanmar, he went to Vietnam, he went to Malaysia rather, and I think he went to Thailand as well. So now this was quick. Now I'm fairly sure that the conversations that he was having was really about very quickly establishing a plan B, if you like, when America, started raising all these tariffs, the tit for tat tariff sort of thing. China needed to protect herself. She needed to secure her regional market, if you like, and that's what that was all about. And so this move on gold, I think, is in some senses an extension of that. And I'm sure that President Xi would have said to some of the leaders in these ASEAN nations, we're quite happy to sponsor a gold vault so that we can trade in yuan and we can trade in gold, whatever you like. I mean, this would be particularly one of the countries he went to was Vietnam.
So carrying on from where we left off, we find ourselves watching this fascinating and frankly very worrying spectacle of a global monetary system in advanced decay. And you can't really overstate the strategic foresight of what China, along with Russia and their SCO and BRICS partners, have been quietly building. They've essentially reverse-engineered the vulnerabilities of the West's fiat empire. Think about this from Beijing's point of view. They understand monetary history quite intimately. It was only back in 1935 that China finally abandoned the silver standard. That's practically yesterday in the long sweep of dynastic history. They know full well that real money is tangible. It's gold, it's silver, not just ink on a central bank balance sheet or some ephemeral digital liability that can be conjured or canceled at will. Which is why, after spending 2 decades hoovering up Western gold during our prolonged bear market, they're now positioning to reshape the architecture of international settlement itself. And the ultimate card up their sleeve is very simple. When the dollar system starts to truly come apart, whether that's because of fiscal blowouts in Washington or a geopolitical event that causes mass dumping of treasuries, China will be ready to pull the trigger on a gold exchange standard for the yuan. Now people say, oh, come on, Alasdair. China wouldn't do that. It would be too disruptive. They'd crater their own exports. That's a very 1990s way of looking at things. China isn't the sweatshop for Walmart anymore. They've moved dramatically up the value chain. They dominate critical technologies, green energy supply chains, rare earths, advanced electronics, and they import vast quantities of commodities, from Saudi oil to Brazilian iron ore. In fact, it's arguably more important for them to secure stable prices for these imports than to keep t-shirts cheap for Iowa, which is precisely why they're laying these foundations. New regional trade agreements settled in local currencies or gold, the Belt and Road Initiative, which effectively chains dozens of smaller economies into Beijing's commercial orbit, and the rapid expansion of gold vault infrastructure from Shanghai to Hong Kong to soon Saudi Arabia. Picture this scenario: a major new round of US sanctions on China, or a blow-up over Taiwan that prompts Beijing to accelerate their timeline. Overnight, they announced that to defend the yuan from speculative attacks, they will now offer to redeem it for gold at a fixed rate, perhaps using the Shanghai Gold Exchange as the operational clearing hub. Immediately, the demand for yuan explodes across Belt and Road nations, across the Shanghai Cooperation Organization. These countries would be only too happy to settle trade in a currency backed by metal, rather than keep holding dollars they know will be printed ad infinitum to cover Washington's deficits. Suddenly, the dollar's exorbitant privilege evaporates. It's not that it goes to zero overnight, of course, but you'd see an immediate structural repricing. Gold would soar not because gold itself changed. An ounce of gold is the same today as it was 5,000 years ago, but because the world's confidence in paper promises would collapse. And then there's silver. Now, if gold is the monetary anchor, silver is the monetary accelerant. Throughout history, silver has often lagged gold's initial moves, but then dramatically outperformed once monetary flight really takes off. Why? Because silver exists in far larger quantities among the general population. It's more accessible. In many ways, it's the money of the common man. And China understands silver's strategic role perhaps even better than we do. Remember, In the late Qing dynasty, the Chinese monetary system was explicitly silver-based. Farmers, merchants, even local officials settled accounts in taels of silver. That cultural memory doesn't vanish in a century. And today, modern China consumes enormous quantities of silver for industrial purposes. Solar panels, electronics, medical tech. What most people miss, though, is that while Western banks have spent decades treating silver purely as an industrial commodity, suppressing it through massive paper shorting on COMEX, the East has steadily accumulated it for strategic reasons. And here we come to the heart of what's happening on the futures markets. You see, the COMEX and the London Bullion Market Association are paper giants. They sell dozens of claims on each actual ounce of metal. This works beautifully when everyone trusts the system and no one tries to convert their contracts into physical delivery. But in the last 2 years, we've seen record numbers of contracts actually standing for delivery. Huge physical outflows from New York and London vaults. And where is this metal going? East, into Shanghai, into Mumbai, into private vaults and sovereign reserves that have zero intention of ever letting it return to the Western system. This is why I keep saying, the game is changing. The Western banks, JP Morgan, HSBC, and their counterparts in London, have relied on a model where they can create infinite paper supply to keep prices subdued. They'd short silver heavily on COMEX, hedge those shorts in London, and profit from the contango. But what happens when more and more players start standing for delivery, and the physical inventory simply isn't there to meet those demands? That's the nightmare scenario for bullion banks. It forces them to buy back shorts in a panic, driving prices exponentially higher. That's the anatomy of a short squeeze, and the current structure of the silver market is practically begging for one. Which brings us to the broader political backdrop, because you cannot divorce these monetary shifts from the crumbling credibility of the US itself. Look at Washington today. You have a federal government running trillion-plus deficits every single year, even outside of recession. The official national debt is $35 trillion. But when you add in unfunded liabilities, future obligations for Medicare, Social Security, federal pensions, it exceeds $180 trillion. Numbers so vast, they're functionally meaningless. Now, the typical Keynesian response is, it doesn't matter, the US issues debt in its own currency, so it can never default. That's true in a narrow technical sense. The US can always print dollars to pay its bills, but the rest of the world is not obliged to accept those dollars at today's purchasing power. And that's where the quiet revolution is happening. Central banks across Asia, the Middle East, even Latin America, are aggressively diversifying their reserves. In 2000, about 70% of global foreign exchange reserves were held in dollars. Today, it's under 59% and dropping fast. Meanwhile, global official gold holdings have climbed to the highest levels in half a century, and we're not talking about a few eccentric regimes. It's the People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, even smaller players like Singapore and Poland, all stacking gold. They're voting with their balance sheets, and they're voting for a future where they are less vulnerable to Washington's sanctions and less exposed to the inevitable devaluation of the greenback. Meanwhile, ordinary investors in the West are largely oblivious. They're stuck in the mindset of 1985 or 1995, thinking the dollar is the eternal king. They have 80%, 90%, sometimes 100% of their wealth in dollar-denominated assets, stocks, bonds, real estate, and they believe gold is some kind of speculative relic. But in reality, gold is doing exactly what it always has. It's holding its purchasing power as the paper around it decays. And we're starting to see the same dynamic emerge with silver. The gold-silver ratio reached absurd extremes, over 100 ounces of silver to buy a single ounce of gold. Historically, that ratio has averaged closer to 15 or 20. Even modest mean reversion would imply a quadrupling of silver relative to gold. Now combine that with the sheer asymmetry in the paper markets. The fact that there are nearly 1 billion ounces of paper silver shorts on COMEX alone, and you have the recipe for the kind of violent snapback that could catch nearly everyone by surprise. The kind of move where silver goes from $30 to $100 in a matter of months. And ironically, many mainstream investors would call it a bubble when in reality it's merely paper illusions being vaporized by physical scarcity. So, where does all this leave us? Well, I'd argue it leaves the average saver in the West in a very precarious position, because most of the narratives they've been sold are false. The idea that U.S. Treasuries are a safe haven, the idea that stocks always recover because the Fed has your back, the idea that inflation is a temporary blip. All of these are comforting illusions, and they work beautifully, until suddenly they don't. That's why you're seeing the smartest capital in the world, the most geopolitically attuned capital, moving into hard assets. It's not that gold is going to make you fabulously wealthy in nominal terms. It's that it will preserve your purchasing power while fiat currencies do what they always eventually do, revert to their intrinsic value of zero. And silver? Silver is the torque on that trade. If gold is your monetary insurance policy, silver is your levered bet on the failure of the current system. You don't put everything into silver. That would be reckless. But you want some meaningful allocation, because when this unwind accelerates, it's silver that will likely deliver the life-changing multiples. I'd also add, and this is perhaps more psychological than purely financial, that owning physical gold and silver has a way of centering your thinking. It connects you to 5,000 years of monetary history. It reminds you that wealth is not just digits on a screen or a promise from a politician. It's something tangible, immutable, beyond the reach of financial engineers and their computer algorithms. So as we move into what I believe is the most consequential monetary realignment since Bretton Woods, with all the volatility, all the geopolitical shocks, all the inevitable media fear-mongering that will entail, those holding real money will sleep the best. They'll watch the show with a sense of calm detachment, knowing that their core wealth is beyond the reach of bureaucrats and bankers. And if you want just one more little sign of how close we might be to the breaking point, look at the rhetoric coming out of places like the European Central Bank or the Bank of England. They're now openly admitting that the gold market represents a systemic risk to the entire financial system. Think about that. They're telling you in bureaucratic language that the entire paper pyramid is vulnerable to a relatively tiny sliver of actual physical bullion. To me, that's not scary. It's validating. It's the culmination of everything classical monetary theory would predict. Fiat systems always overextend. They always breed political corruption, moral hazard, reckless debt accumulation, and they always end the same way, in a return to real money. So in closing, I'd simply say, don't let volatility shake you out. Don't let financial media narratives gaslight you into thinking gold and silver are barbarous relics. They are the insurance policy on a system that, by every rational measure, is in its final phase. Stay calm, stay diversified, keep stacking. Because when this monetary reset finally hits its crescendo, the window to reposition will slam shut, and those holding real money will be holding the ultimate trump card.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.